I'm Dawson Schmidt here with the latest stories and developments in this week's Commodity Roundup on Trader PhD.
Cargill plans to lay off about 5% of its workers as part of a plan to boost its workforce efficiency. An internal memo from the company CEO Brian Sykes obtained by Bloomberg outlined that the reductions will take place this year. Sykes says the cuts will focus on streamlining organizational structures, expanding the scope and responsibilities for managers, and reducing work duplication. The memo comes as Cargill and other competitors such as Bunge and ADM face lower margins following lower crop prices after a bumper season. Cargill's beef segment also faced heavy pressure from lower cattle supplies and higher prices. Tyson's Foods announced this week that it will suspend operations at its Emporia, Kansas plant by mid-February to cut costs amid a downturn in the beef industry. The company last halted operations at the facility in 2008 due to excess capacity in the industry. In a postponed earnings call, ADM says it will expect lower commodity prices to continue to drag on profits in 2025, forcing the company to rely on cost and cash management. Crop traders are facing lower soybean crush margins in the U.S. due to biofuel uncertainty and increased farmer sales in Argentina. ADM says overall supplies, especially for soybeans, will continue to weigh on market conditions. Australian cattle producers received some welcoming news after China lifted some restrictions on meat imports from the country. Bloomberg reported that Beijing ended its ban on 2 Australian meat processors that had been banned from selling to China. Lifted restrictions could mean increased competition for U.S. beef exports, as Australia will see a full resumption of beef exports to China. Improving trade relations come as Australia boosts its cattle slaughter rates to meet global demand. Chinese customs data showed that the country's beef imports for the first 10 months of the year are up 4% compared to 2023. However, U.S. exports to China are down 8%, primarily due to tighter domestic supplies and higher export prices. Brazil has helped offset some of that difference, exporting 12% more beef from January through October. Meanwhile, Australian shipments are down 11%, though exports are up 16% from the same period in 2022. Pakistan is expected to import more cotton during the current marketing year as the country faces lower production. Bloomberg reported that the country could import about 6 million bales during the 2024 and 25 season. That compares to the 4 million bale forecast from the USDA's November WASDE report. Adverse weather over the past 2 seasons led to lower output, increasing the country's reliance on foreign supplies. High production costs are also limiting cotton planting. U.S. cotton exporters are expected to benefit from the shortfall. U.S. shipments of upland cotton to Pakistan are up 118% from the previous marketing year. Thanks for watching. I'm Dawson Schmidt, and this has been Trader PhD.